There's a brand new retirement plan that a large company just launched that could change the way the entire stock market works. And no, not in a good way. IBM just canned the 401k in favor of bringing back the pension. Now, this is a different type of pension than the typical one. This is called a cash balance plan. But first, what did they get rid of? The 401k is the most common type of retirement plan today. It allows you and sometimes your employer as well to make contributions into an account that you own and you control. You have the choice on how to invest that money, whether it's in stocks, bonds, or cash. The money that goes into that account is yours. You own it. It belongs to you, and you are able to move it to a new retirement account when you change employers, and you can also take money out of it at any time, at any rate when you retire. By the way, if you are not currently taking full advantage of your retirement account by using things like self-directed retirement accounts and Roth, backdoor Roth contributions, I teach you everything you need to know about retirement accounts as just one of the courses included in Heresy Financial University. And I'm currently running a Black Friday sale. If you use code Thanksgiving for the annual plan only, you get the annual plan for half off. The code expires Cyber Monday, so sign up below. Now, while I'm not the biggest fan of putting all your eggs in the 401k basket and relying on that for all of your retirement needs, in my opinion, there is no comparison between a 401k and a defined benefit plan like a pension, because a defined benefit plan like a pension is opposite in almost every way to something like a 401k. You don't own the assets, the company does. You don't control how it's invested, the company does. You don't control how much you take out when you retire, the company does. And in my opinion, if you don't control something, you don't own it. You're simply dependent on the goodwill and the competence of the people who really do own it. Now, Michael Green and Jeffrey Snyder were recently talking about this very thing and how it could really change, could impact negatively the entire stock market if other companies follow along. And as a result of the lucrative cash savings that IBM is going to happen as a result, other companies are going to be watching this very closely. First, IBM is completely stopping its matches to its employees' 401k plans. Instead, they're starting an automatic 5% retirement benefit with the new cash balance defined benefit plan. Now, when you break this down and look at what's really going on here, it basically is IBM issuing IOU notes to its employees instead of giving them money to their defined contribution plans like they used to. As a result of interest rates now being at a place that they haven't been for decades, many companies are going to be looking at this as, number one, a way to offer something to their employees that their employees might see as more valuable, and number two, not have to go out and raise financing from a market that has gotten more expensive. With interest rates so high, it can become very expensive for companies to go out into the marketplace and issue bonds to the market, borrowing money at these really high interest rates. Instead, by switching over to a cash balance defined benefit plan, they turn their employees into the people that are funding them as a company, and all they have to do in return is give them an IOU that says at some point in the future, I'm going to pay you back. And don't worry, because it's guaranteed, which means that instead of employees being able to rely on, number one, a 401k that they put money in, that they own the money in it, they control how it's invested, and they can take it where they want, they can choose how to take the money out, they're relying on the competence and the goodwill of this company to make good on their IOUs. Now, it is true that there's an organization called the Pension Benefit Guarantee Corporation, and if something happens to IBM, then a portion of those pension payments is guaranteed by this organization. But as with all federal organizations that guarantee to bail out something in the case of a collapse, it is woefully underfunded, which means that if we do have some sort of a pension apocalypse, or IBM in this case goes under, then you would most likely need some sort of a bailout through a bunch of money printing in order to make it whole. Now, it is also true that there is a retirement crisis in this country. Most people, especially older people, do not have anywhere near enough saved in their retirement accounts in order to retire. They're going to be almost fully dependent on Social Security and the small amounts that they do have saved up. If we take a look at the amount that people have in their 401ks by age, we can see the group that has the most most, ages 55 to 60, still only has an average of $199,000 in their 401k. If you are forced to live on this and you take out even $50,000 to live on for 1 year at a time, this account is only going to last you 4 years. But that's just the average. If we take a look at the median, we see an even worse picture, with the median balance of 55 through 60-year-olds being $55,000, enough to last just 1 year for most people's average expenses. This means that especially for older employees, a move to a defined benefit plan might be seen as a very welcome move, something to bail them out from a lifetime of not saving. And it may even be enough to encourage some of them to retire, freeing up room on the budget for these employers to hire lower paid, even though they're less skilled, newer, younger employees. So it looks like this could turn out to be a big win for older employees at IBM. It also looks like it's going to be a big win for IBM as a company. For the next moment, I'd like to share with you about a very important company who is sponsoring today's video, Monetary Metals. The reason why Monetary Metals is doing something so revolutionary goes all the way back to when FDR outlawed gold ownership with Executive Order 6102. What a lot of people don't know about this gold confiscation was that it also outlawed the gold clause that was very common in debt contracts, which allowed people to get their debt paid back to them in gold if they chose. Fast forward from there to 1971, when the US left the gold standard for good, there's no longer any reason to keep this law in place. But what even fewer people are aware of is that this law was actually repealed, which meant that it became legal to denominate debt contracts in gold yet again. Now, for the longest time, I was not aware that this was legal in the United States, let alone that there was any company out there actually doing it. However, when I discovered Monetary Metals, I realized this is exactly what they're doing, and nobody else is. They have created a way for you to get on your own personal gold standard by paying you a yield that is denominated in gold, it's priced in gold, and it is paid in gold. They have multiple offerings like leases that pay between 2 and 5% and bonds that have paid up to 19%. Now, just to be clear, this means that if you start off with 100 ounces of gold at 4%, then you end the year with 104 ounces of gold. The yield is denominated and paid in gold, regardless of what the price of gold does. Your gold is actually growing. Now, I have spent quite a bit of time over the last 2 years now researching how this company does what they do. I've gotten to know the team, and as a result, I've not only become a customer of the company myself, I use the products, but I've also invested into the company personally. Monetary Metals is doing something truly unique, revolutionary, by paying you a yield on your gold, priced in gold, and paid in gold. And I highly recommend and encourage you to click on the link in the description below and open up an account today. But how could this affect the stock market overall? Well, Michael Green has detailed for many years now how the stock market is becoming more and more of a passive investing bubble. And I've made videos about this in the past as well. But essentially, the entire stock market goes up as long as there are just people buying. And most of the buying that happens in the market happens as a result of 401k contributions today. Now, I want to ask you a question. When you get your paycheck and a 401k contribution is made, are you going into your 401k and are you choosing, I would like to buy this stock because it looks undervalued, I'd like to trim my position of this stock because it looks overvalued, and are you rebalancing your portfolio with price discovery, looking at actual valuations? I guarantee you that almost nobody listening to this video right now has ever done that. 99.999% of 401k contributions that are made are, I get my paycheck, portion goes into the 401k, and an automatic purchase is made of the entire stock market just because I got money. This has been the conventional wisdom for just a couple of decades now, that you should buy at any price so long as you continue to buy the same dollar amount over time. This method is called dollar cost averaging, and its success assumes that the dominant players in the market are seeking value, that there is active price discovery happening. Because if you have 10 players and 9 of them are all making active, intelligent investing decisions, trying to buy the things that look undervalued and sell the things that look overvalued, you're going to have one of them that is very wrong, one of them that is very right, and you're going to have an average mix of everybody else. The resulting price action of the assets that are being bought and sold will result in average performance over time. So you as one player can come in and piggyback off of that and just ride the averages, and you'll get the average of the best and the worst active price seekers. Because when everybody is looking for value, there will be some people who are wrong, will be some people who are right, and the difference will be averaged out and will reveal itself in the price. You as a passive investor can ride their coattails. But this style of investing does not work if everybody is doing it. Over the last few decades, we've seen pretty much the death of active investing. We've seen the nails go into the coffin on active investors as more and more money managers and investment advisors transition their clients and their books from active investing to passive investing. And every single time somebody gets a paycheck, a portion of it goes to buy the entire stock market, regardless of the price, regardless of the value. And it continues to work only to the point where people keep on buying at any valuation, which is why this move with IBM moving to a defined benefit plan is so big. If this is received well and other companies realize the massive win that IBM just got from this, they will try and follow suit, which means that more and more large corporations may be moving away from the 401k plan, which pushes their employees into buying the stock market at any price, regardless of value, and instead invests entirely in fixed income. This could very well turn the tide. The entire stock market is only as overvalued as it is because every employee in America buys at any cost because they're already using 401k plans. And if the biggest corporations make a move away from that, from these defined contribution plans that push people in the stock market and transition to defined benefit plans, pension plans that are entirely fixed income, this removes the main buyers in the market. And when everybody is a passive investor and then all the buyers leave the party, the only way the market can go is down. Now, obviously, this is not a short-term thing. It will require much more than just one company like IBM making this shift. But there's an old proverb that says, do not underestimate the day of small beginnings, which basically means something very small can spiral, it can snowball and become something very large in the future. This is absolutely something to watch because if this trend continues, it could very well pop the passive investing bubble that has been growing for decades. Now, for the longest time, I've been making videos about the dangers of passive investing because in reality, there is no such thing as passive investing. Investing is inherently active. And so if you're not active in your investing, you're just gambling. You're buying every single stock that's out there just on the hopes that everybody else will continue to buy those same stocks. That's not investing. Investing is looking well into your investments and having as high of a degree of certainty as possible that what you are buying will produce a good return for you. You are purchasing value. Now, that doesn't mean you can't use index funds. I'm a huge fan of ETFs. Use ETFs to get exposure to isolated sectors, industries. Many ETFs are optionable, which means you can hedge. But the point is being active in your investing. And as this whole thing unwinds, active is going to start making a huge comeback. And it's the ones who have practice seeking value that are going to be able to recognize all of these assets that go wildly on sale because everybody who was buying before just because everybody was buying everything will turn into sellers selling everything just because everybody is selling everything. And there will be some assets that are wildly undervalued and primed for purchase, primed, just ready for the people who have been actively seeking value. And if you don't know how to do that, you need to sign up for Heresy Financial University. Use code Thanksgiving on the annual plan because it gives you your first year half off, which means you get your entire first year of membership to Heresy Financial University for the cost of just 5 months of the monthly plan. Link is in the description below, and the code expires Cyber Monday, so don't wait. As always, thanks so much for watching. Have a great day.